Welcome back to the channel. Today we're taking a deep look at SoFi Technologies, ticker SOFI, and asking one important question. After a major decline in the stock price during 2026, does SoFi now offer an attractive long-term opportunity, or is the market correctly pricing in the risks? SoFi has evolved far beyond its original student loan business and is now building an integrated digital financial services platform, combining lending, banking, investing, payments, and technology. In the second quarter of 2026, SoFi delivered record-adjusted net revenue of approximately $1.2 billion, up 40% year-over-year, while GAAP net income reached approximately $157 million. SoFi is essentially trying to become a one-stop digital financial platform. Its business is divided into three major areas: lending, financial services, and technology platform. Lending remains the largest contributor, including personal loans, student loans, and home loans. Financial services includes products such as checking and savings, credit cards, investing, brokerage, and other financial products. The technology platform provides financial technology infrastructure to other institutions. The long-term investment thesis is that SoFi can use its growing customer base to sell multiple products to each member, increasing revenue per customer while lowering customer acquisition costs over time. One of SoFi's most important metrics is member growth. By the end of the second quarter, SoFi had approximately 15.8 million members, after adding roughly 1.1 million members during the quarter. This matters because SoFi's strategy is not simply to acquire customers for one loan and then move on. The company wants customers to use multiple financial products inside the same ecosystem. As the number of members grows, SoFi gets a larger potential customer base for deposits, credit cards, investing, loans, and other services. The second quarter was another strong operating quarter for SoFi. Adjusted net revenue reached approximately $1.219 billion, representing roughly 40% year-over-year growth. Adjusted EBITDA was approximately $358 million, up around 44% year-over-year, while GAAP net income was approximately $157 million. This was also the company's 11th consecutive profitable quarter, showing that SoFi has moved beyond the stage where growth comes entirely at the expense of profitability. Lending remains the core engine of SoFi. In second quarter 2026, total loan originations reached approximately $14.8 billion, with personal loan originations around $10.7 billion. Student loan originations also surged, reaching approximately $2.7 billion, while home loan originations were around $1.4 billion. The important point is that SoFi is growing across multiple lending categories, rather than depending entirely on one product. Of course, lending growth always comes with credit risk. The positive development is that SoFi's personal loan net charge-off rate was reported at approximately 2.62%, lower than the roughly 2.83% level in the prior year period. That suggests credit performance has remained relatively controlled despite the company's rapid lending growth. However, investors should continue monitoring unemployment, consumer credit conditions, loan delinquencies, and charge-offs because a deterioration in the economy could directly affect SoFi's profitability. Another major advantage is SoFi's banking operation. Deposits reportedly reached approximately $45.5 billion during Q2, providing a large source of funding for the lending business. This is strategically important because SoFi does not need to rely entirely on more expensive external funding to support loan growth. A growing deposit base can potentially improve the economics of the lending business, while also deepening customer relationships. The financial services segment is becoming increasingly important to the overall SoFi story. The company wants members to use SoFi for everyday financial activities, including saving, spending, investing, and borrowing. The more products a member uses, the greater the potential lifetime value of that customer. In second quarter, SoFi's fee-based revenue reached approximately $472 million, representing about 39% of total revenue and increasing roughly 22% sequentially. This is particularly important because fee-based revenue can help diversify SoFi away from pure lending economics. There is, however, one major weakness investors cannot ignore: the technology platform. This business has significant long-term potential because SoFi can provide infrastructure to other financial institutions, but its near-term performance has been volatile. During second quarter, technology platform revenue was reported at approximately $84.5 million, down about 23% year over year, partly because of the loss of a major customer. That weakness was one reason investors reacted negatively despite the strong overall quarterly numbers. SoFi's biggest long-term opportunity is its attempt to become an everything app for personal finance. Instead of being just a lender, the company wants to control more of the customer's financial relationship. Imagine a customer joining SoFi for a checking account, then adding direct deposit, savings, investing, a credit card, a personal loan, and eventually a mortgage. If SoFi can successfully increase the number of products used by each member, revenue growth could eventually outpace simple member growth. That is one of the most important parts of the long-term bull thesis. Management has already increased its full year 2026 adjusted net revenue guidance to approximately $4.75 billion to $4.85 billion, representing roughly 32% to 35% growth. The company maintained its adjusted EBITDA target of approximately $1.6 billion, adjusted net income of approximately $825 million, and adjusted EPS guidance of around $0.60. Raising revenue guidance while maintaining profitability targets is an encouraging sign that management continues to see strong underlying demand. Looking toward 2027, I believe the key question is whether SoFi can continue growing revenue at a rate above the broader financial services industry while expanding margins. My base case assumption is that revenue growth gradually moderates as the company becomes larger, but remains strong enough to support substantial earnings growth. If SoFi can continue expanding its membership, deposits, cross-selling, and fee-based revenue while maintaining disciplined credit underwriting, 2027 could become another major earnings growth year. For my base case model, I would estimate 2026 adjusted revenue around $4.8 billion, followed by approximately $6.0 billion to $6.2 billion in 2027. That would represent another strong year of growth, without assuming that SoFi maintains its current 40% quarterly growth rate indefinitely. The reason I prefer this more conservative approach is that valuation models should account for the natural slowdown that typically occurs as companies become larger. On earnings, 2026 adjusted EPS guidance is approximately $0.60. If operating leverage continues and revenue grows as expected, I believe 2027 adjusted EPS could potentially move toward roughly $0.85 to $1.00 in a reasonable base case. The upside scenario would require stronger than expected member growth, better margins, and continued strength in lending and fee-based businesses. The downside scenario would involve slower loan growth, higher credit losses, or weaker technology platform performance. SoFi is not a traditional bank, and I would not value it using only a conventional bank multiple. Investors are paying for a combination of financial services, fintech growth, and technology platform potential. At the same time, the company cannot receive an unlimited growth multiple because lending remains a large part of the business. With the stock recently trading around the mid to high teens, the market is clearly demanding evidence that SoFi can translate its strong operating growth into sustainable earnings growth. Current market data has recently shown SoFi around the mid-teens, with significant volatility during 2026. In my bull case, SoFi continues growing members rapidly, fee-based revenue expands, credit remains healthy, technology platform revenue recovers, and operating margins improve. Under that scenario, I could see 2027 adjusted EPS approaching or exceeding $1. If the market awards SoFi a premium growth multiple of approximately 30 to 35 times earnings, that could produce a 2027 valuation around $30 to $35 per share, with additional upside possible if growth significantly exceeds expectations. My base case scenario is more balanced. I assume revenue continues growing strongly but gradually slows, earnings expand, credit losses remain manageable, and the technology platform recovers only gradually. Under these assumptions, I would place a reasonable 2027 fair value range around $24 to $28 per share. That would represent meaningful upside from the recent mid-teen trading range, but it would still require SoFi to execute successfully over the next several quarters. In the bear case, the biggest threats would be a weaker consumer, rising unemployment, higher loan losses, slower loan originations, and continued weakness in the technology platform. If earnings growth disappoints and investors assign SoFi a much lower multiple, the stock could remain around the mid-teens or potentially move lower. This is why SoFi should be viewed as a growth-oriented financial stock rather than a low-risk traditional bank. The first major risk is credit. SoFi is growing its lending book rapidly, so an economic downturn could increase defaults and charge-offs. The second risk is valuation volatility. Even when the business performs well, the stock can fall sharply if investors believe future growth is slowing. The third risk is competition. SoFi competes against banks, fintech companies, brokerages, and other digital financial platforms. Finally, technology platform execution remains a risk because losing major partners can create significant short-term revenue volatility. Over the next several quarters, I would focus on 5 numbers: member growth, total deposits, loan originations, fee-based revenue, and adjusted EPS. I would also closely monitor credit quality and technology platform revenue. If members continue growing by around 1 million or more per quarter, deposits keep expanding, fee-based revenue continues increasing, and earnings growth remains strong, the long-term thesis becomes significantly more attractive. Putting everything together, my 2027 bear case target is around $15. My base case target is $24 to $28, and my bull case target is $30 to $35. I would consider approximately $26 per share a reasonable central target for this analysis. The bull case is possible, but it requires continued exceptional execution across lending, financial services, and technology platform. So, is SoFi a buy? Fundamentally, I believe the company has become much stronger than the SoFi of several years ago. It now has a large and rapidly growing member base, a substantial deposit franchise, diversified financial products, growing fee-based revenue, and consistent profitability. The biggest question is not whether SoFi can grow. It clearly can. The bigger question is whether the company can maintain strong growth while keeping credit losses under control and turning that growth into increasingly powerful earnings. My final view is buy for long-term growth-oriented investors, but with the understanding that SoFi is a volatile stock and not a low-risk investment. My base case 2027 target is approximately $26, with a bull case range of $30 to $35 and a bear case around $15. If SoFi continues delivering strong member growth, expanding fee-based revenue, and increasing profitability, the stock could eventually deserve a much higher valuation. But if credit quality deteriorates or growth slows sharply, the downside could also be significant. SoFi is one of the more interesting fintech stories in the market because the company is attempting to combine the economics of a bank with the growth profile of a technology company. The next few quarters will be critical in determining whether that strategy can continue working at scale. If you enjoyed this analysis, make sure to like the video, subscribe to the channel, and turn on notifications for more 2026 and 2027 stock analyses, price targets, and fundamental breakdowns.